Hello everyone. Welcome to our discussion sessions on official mock exam issued by ACCA for Advanced Audit and Assurance Level Exam for June 2025 attempt. In our today's class, we will be looking at question number 1 of this official mock exam. Discussion of these complete exam papers is really helpful for the students in finalization phase of their exam preparation. See, all of the students practice topical questions when they are studying the course. But when you go for your actual examination, where you have to deal with all of the topics together, at that time students get confused. They are not able to apply their drafting techniques when they are dealing with a complete exam paper, and they also struggle with time management issues. So practice of these complete exam papers, looking at these mock papers before your actual examination is really helpful for your preparation. In our today's class, we will be evaluating this complete question number 1. We'll read this entire question along with all of the exhibits. And then most importantly, we'll be drafting the complete answer in our today's class. I've been keeping this series of past paper discussion sessions in which we will be discussing almost 10 complete attempt exam papers in which I will be solving these complete papers with you guys. We'll be discussing the points, then we'll be drafting the complete answers. And then I will be giving 3 mock exams to my students, which they have to attempt on their own and send me for marking and feedback. So our today's class is on question number 1 of this official mock exam. Now, this mock exam question of June 25 exam paper is same as the mock exam which we discussed in December 2024 attempt. So now I will be connecting my class with that particular session in which I discussed my December 24 mock exam. So it's the same question. Okay, we'll be discussing this entire question paper, but now there will be a slight change in the video. It's the same question Tahoma Associates, which is in December 24 attempt. So now I'm getting my class with that session in which I have discussed this complete exam paper. Your patience and concentration will be really important while we discuss this complete exam paper, and particularly in our today's class when we are looking at question number 1. Okay, so let's start with the discussion of this question, which is Tahoma Associates, in which we are working as a manager in the audit department. Okay, so let's start with it. It is 1st July 20X5. You are a manager in the audit department of Tahoma Associates, a firm of chartered certified accountants responsible for the audit of Calibri Company for the year ending 30th September 20X5. Calibri Company, a family-owned, non-listed entity which operates car sales and servicing locations under franchise agreements with car manufacturers. So it's just an introduction about the question that we are working in Tahoma Associates. Our client is Calibri Company. Year end is 30th September. It's an unlisted entity. So it's an introduction. The examiner is briefing us about the scenario. See, when you are reading the question for the first time, it is very important that you read it with patience and concentration. Try and identify maximum possible topics. Don't rush. Don't get frustrated that the question is difficult or easy. Believe me, every question is easy. It's all about how you approach that question. Okay, now. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Exhibit 1, partner's email, an email which you have received from Gil Sands, the audit engagement partner. Exhibit 2 is company information, background about Calibri Company, current situation and business activity. Exhibit 3 is meeting notes, summary of events during the year as discussed in a meeting between Gilsons and finance director. So these all are the exhibits which we will be obviously looking in detail when we will be drafting the answer. Interim inventory count extracts points of concern raised during the count. And Exhibit 5 is sustainability reporting, details of the request by the directors of Calibri Company to assist with sustainability matters. The information should be used to answer the question requirements within your chosen response options. I hope you all remember that there are two response options at advanced audit and assurance level. One is the word processor in which you type the answer, and other is the spreadsheet, which can be used for calculation, but the calculations can be done on word processor also by using the table tool. When we'll be looking at the detail of the answer drafting, obviously we'll be looking that how you have to use these response options. Okay. So let's read this exhibit one, which is partner's email. And in question number one, all the requirements are stated in this exhibit one, which is partner's email. To audit manager from Gilson's audit engagement partner. Subject audit planning for Calibri company. Date is 1st July 20x5. Help. You need to start planning the audit of Calibri company for the year ending 30th September 20x5. And to help with this, I have provided you with some relevant information. I met with the finance director yesterday to discuss a number of matters, including some recent business developments. In line with the internal quality procedures of Tahoma Associates, I have determined that profit before tax should be the basis for calculation of materiality. You all know that as per the auditing standards, there are three benchmarks for materiality. It can be revenue, it can be profit before tax, and it can be assets. Now, in these benchmarks, there are thresholds defined, like for profit before tax is 5% to 10% of PBT. And we have to use our judgment skill to pick up the materiality level from that. Whenever you are dealing with answers of risk of material misstatement and audit risk, there are marks for this professional judgment skill. Okay, so as we move forward, we'll be looking at it. Here we know that the benchmark for materiality is profit before tax. Using the information provided, I require you to prepare briefing notes for my own use, in which you, using all exhibits, evaluate the significant business risk to be considered in planning of Calibri company audit. One of the routine requirement for question number one, audit planning, when the examiner asks you to evaluate the business risk. Okay, for 10 marks, so each business risk worth 2 marks, so you have to write 5 business risk. Okay. Then, using exhibit 2 and 3 only, evaluate and prioritize the significant risk of material misstatement to be considered in developing the audit strategy and the audit plan. Using profit before tax as your benchmark, you will need to determine and apply appropriate materiality threshold in your briefing notes. You are not required to consider risk of material misstatement arising with respect to inventory held by Calibri company. So it's 12 marks in relation to risk of material misstatement only, and it's exhibit 2 and 3 which we have to consider. Okay? Using the exhibit 4, justify why the inventories of parts and pre-used cars have been identified as a significant risk of material misstatement. And design principal audit procedures to be performed on the valuation of used car inventory, 10 marks. So you have to give justification or the reasoning why the used cars and the parts are considered as a risk. So each justification will worth 1 mark. Now this is the type of requirement which you are finding in RMM nowadays. We have discussed a complete article in relation to it in our class discussions when we were discussing risk of material misstatement, that how you have to develop these justifications. Each justification will worth 1 mark. And then you have to write procedures. Obviously, you know how you have to do the drafting of the procedures. So 10 marks for business risk, 12 marks for RMM, then justifications, reasoning that why you are considering the inventory as high risk in this question, and then referring the audit procedures. Then using the exhibit 5, part D1, discuss the ethical and professional issues arising from the director's request for Tahoma Associates to provide the systems and KPIs for the sustainability reporting, including providing the sustainability assurance service, and determine which of these service, if any, would be provided by Tahoma Associates, 8 marks. So it is one of the routine question number one when you have business risk. You have risk of material misstatement, you have audit procedures, and then you have a requirement in relation to ethics because the client has requested us to provide some non-audit services in relation to sustainability. So this is one of the routine question number one which you can have. Other type is that when you have a requirement in relation to audit risk. So here he didn't ask us about the audit risk, he asked about us about the business risk and the risk of material misstatement. Okay. So let's move forward and look at other exhibits. Obviously, we'll be looking at the drafting of the answer, starting from the business risk, then ROMM, then the justifications, procedures, and then as we move forward, we'll be looking at the ethics part also. This is just the initial reading of the question, so it's very important that while we are reading the question, you listen to it carefully. Okay, let's look at it. Okay, so Calibri Company is a family business which was incorporated 30 years ago. Calibri Company trades under a franchise agreement with a single manufacturer, Perpetua Cars Company, in 8 locations. All these locations are in same country as the manufacturer, so there are no foreign currency transactions. The business comprises 2 divisions: car sales. Car sales are made from showrooms as part of a dealership franchise package with Perpetua Cars Company. Calibri Company is permitted to sell new Perpetua Cars Company vehicles from the manufacturer in that specific territory under the franchise agreement. The agreement requires a single upfront fees of $800,000 for each showroom location. This gives Calibri Company right to sell vehicles manufactured by Perpetua Cars Company and make repairs to pre-used cars using manufacturer's approved parts. The fees is non-refundable and paid only once upon opening of each new showroom. So basically, we can only sell the cars of Perpetua Cars Company. Okay, we pay an upfront franchise fees and we get the rights to sell their vehicles. Franchise agreement lasts 10 years and can be withdrawn without refund if franchise conditions are not met. These include requirement to update fixtures and fittings as required by Perpetua Cars Company to ensure a consistent brand image and to meet certain customer service and sales volume key performance indicator. Providing these requirements are met, it's customary, means normal for franchise agreement to be renewed automatically after the initial 10-year period. Historically, Calibri Company had always franchise agreement renewed and as such have determined it is appropriate to capitalize the upfront fees and assume the asset have an indefinite life because normally the licenses get renewed. Now, when you are assuming that, okay, it has an indefinite life, so this means that every year you will be required to do impairment testing and make an attempt to estimate the life because the renewal is dependent on meeting the conditions because the license can be withdrawn anytime if we fail to meet the conditions. So this is one of the accounting issue that the locations where the sales are declining or something like that, then impairment issue may arise in that regard. Perpetua Company, Cars Company own the car show, which are then leased by Calibri Company for a fixed duration of 10 years. See, now this is also one of the problem. Basically, what Perpetua Car Company do is that they purchase a car showroom, the asset is theirs, and then they give it to a franchise to Calibri Company. If the franchise is withdrawn by the manufacturer, Calibri Company will pay a penalty fees to exit the property lease early. So basically, if our license gets cancelled, the franchise license, first of all, the license fees of 800,000 we paid, that gets wasted. And secondly, since the showroom is of Perpetua Car Company, we will also be required to pay the early lease withdrawal. Each showroom location is treated as a separate cash generating unit. Calibri Company customers can part exchange their old cars and receive an allowance against the cost of new car at Calibri Company location. These part exchange cars are then serviced and sold as pre-used vehicles. So apparently one of the major business risk of Calibri Car Company is the nature of agreement they have with Perpetua. that the Perpetua car company can cancel the lease agreement. The showroom is in the ownership of the Perpetua car company. And if they cancel the lease agreement, the problem is that in that case, we'll have to pay then the early lease cancellation also. Okay. First of all, our license fee get wasted. And secondly, we also have to pay the early termination from the lease agreement. Servicing and repair. Calibri company operates a car service and repair facility at each of its showrooms. Repairs are carried out in a motor vehicle workshop, and large amounts of car parts are held in inventory to enable repairs to be made in timely manner for the customers. Customers have the choice to pay for the manufacturer approved parts or opt for cheaper generic vehicle parts. So that's completely normal in the industry that if the people are not willing to take the approved parts, so they can have the cheaper parts for that purpose. Okay, so we are looking at each of the exhibit and we are drafting the relevant points. We are thinking about that how we will be picking up the business risk in that regard. So apparently, if we look at this exhibit, the business risk was in relation to the Perpetua agreement, which is a bit unfavorable from regard of Calgary company, that the license fees is unrefundable. They may cancel the agreement if the sales volume indicators are not satisfied. So since you are in car industry, if there are economic situation or due to any reason, you are not able to meet the sale targets, your license may get cancelled, the franchise agreement may get cancelled, then as a result, the franchise fees which you have paid will get wasted. And most importantly, the lease exit clause will also get applicable. Okay, let's read further. Then we have the meeting notes. Let's look at them. Okay, now, projected financial results. Revenue has increased from the previous year. It has increased from 175 to 182. Profit before tax has increased from 16,900 to 19,300. The total assets have also increased. New car sales represent 70% of the Calibri company projected revenue for the year ending 30th September 20x5. At present, Perpetua Car Company do not have any range of electric cars. However, they are planning on release first electric car in the market in 20x8. You all know that the technology is moving towards the electric cars and they don't have the electric car, which is a limitation which will impact the Perpetua Car Company also and us also, because we are their franchisees. Okay, because if the trend will change, if the practice of the market will change, people will shift to electric car, and Perpetua Car Company do not have the electric cars. The sales will decline, and when the sales will start to decline, the problem will be our franchise agreements will get in problem. We have paid $800,000 for each of the franchise agreement. Loss of a franchise location. Perpetua Car Company has provided Calibri Company with a notification of their intention to withdraw franchise right at one of their locations. So the risk is getting materialized. Calibri Company obtained a franchise right for the location on 1st October 20x2. And you look at it, it's getting withdrawn in 3 years, 2003, 4 and 5. In 3 years, it's getting failed and has failed to meet the sales target required by Perpetua Company, resulting in revocation of the agreement. The franchise fees of $800,000 is non-refundable. In addition, a $350,000 penalty will be required to terminate the lease. Such a big loss, $1.1 million, almost $1.1 million and $50,000. Such a big loss. You cannot do anything because you just fail to meet the sales target. And sales targets, meeting them are not always in your hand, because maybe due to economic recession, the new cars are getting sold lesser. Our 70% of the sale is coming from the new cars. And when the economic situation will get worsened, automatically people will shift to used cars. And our sale, 70% is from new cars. So that will become a big concern for us. Okay. Fixtures and fittings, $120,000, used cars, parts. The finance director of Calibri Company has stated that these assets will be utilized at other sites. No adjustment have been made to projected financial statement in relation to the loss of franchise. From the accounting perspective, that's completely wrong. You need to book the provision for this penalty because now it's an onerous lease agreement. You need to book impairment for this license, this franchise fees, $800,000. And in relation to other assets also, like maybe used cars and parts can be used other side. But in fixtures and fittings, there will be the impact of impairment. Okay, because when one site has got closed, one of the franchise had got closed, you had around 8 franchises in total, if I'm not wrong. How many showrooms we had? Um, I think it was written somewhere in the start, 8 or 6 franchises we have. Um, I think that was written in the introduction. If we just go and look at it, okay, we have some number of showrooms. It was written somewhere. Okay, we'll look at it as we read forward. We'll find it. In 8 locations, yes, we had 8 franchises. Okay, now when we have 8 franchises, from that one franchise is getting closed. So obviously, we don't have hundreds of franchises to accommodate all of the parts. So there will be impact of excess things getting created. Okay. Potential future listing. Calibri company has decided to obtain stock exchange listing and is hoping for initial offering of shares to be made during the 6 months to 30th September 2026. So you are apparently going for listing in the next year. Wait a minute. You have just lost one of the franchise agreement. You are going for listing. So maybe your listing won't be very much successful. You won't be able to attract a lot of investment in that time. Your timing of listing is not good. With this in mind, board of directors are keen to ensure that financial statements show a strong performance for the year. So apparently, this is a risk of material misstatement that they may do some manipulation in the books. Audit committee and internal audit. In order to improve company controls prior to listing, Calabri Company recruited a newly qualified accountant with experience in external audit. The company aimed to create an internal audit department and hopes that by 31st December that this will have 2 full-time staff. In addition, Calibri Company has appointed 2 independent non-executive directors from the car industry and intend to have them recruited by 31st December so they may create an audit committee that is independent. Neither of non-executive directors appointed to date have financial experience or expertise. Currently, I'll say that they are not ready for the listing. It's all matched. You don't have an internal audit. You don't have non-executive directors. Your audit committee is also insufficient. You need to have at least one accounting expert in audit committee. And you are planning to go for the listing in 30th September 2026. Like it's just 1 year time. How? And you are planning to get listing in the first 6 months, if you can look at it. In 6 months, you are saying that we'll go for listing. Apparently you're not ready for listing. So even if you go for listing, your cost of compliance will increase a lot, and apparently you may face penalties due to the extra governance requirements which you won't be meeting. And the timing of the listing itself is wrong because you are just losing one of the franchise agreement and you are saying that I want to go for listing. So in this time, if you go for listing, obviously you won't be able to attract good investment. You need to go listing in best of your times so that when you go for the issue of shares, your initial issue, you can attract a lot of capital. Apparently, the timing of listing isn't good. Okay. Exhibit 4 is in relation to interim inventory count extract. Okay. We'll obviously be looking at the question in more detail as we move forward towards the drafting. Full inventory counts are performed once in a year in March, and then year-end figure is obtained via a roll forward transaction from the date of inventory count to be the year-end. Okay, like they perform the count every year and then they just adjust the purchase and sale figures to arrive at the closing figure. Okay, the parts 480 they have increased to 580. Your parts have increased a lot. Your used cars have increased a lot. So there is a risk that a lot of obsolete stock is included in it. Okay, and these counts have been performed in March. Okay, and if you look at your year end, your year end is 30th September. Okay, so obviously the question that why you are considering inventory as high risk, these are the reasons. The latest inventory count was attended by the audit team and systems for monitoring inventory level, and count procedures were assessed as adequate after control testing. And spot counts were also performed. However, the audit supervisor highlighted the following concerns in the following area. Parts. It was noted that during the count, the inventory is marked with a colored sticker to show that it has been counted. The color of the sticker is changed each year to avoid confusion. It was noted during the count that some of the parts were marked with as many as 5 different colored stickers. that indicates that those parts are getting obsolete because they have been in the inventory for 5 continuous counts. Because in every count, we put a different color sticker. So apparently, they are not doing the adjustments for the obsolete inventory. Okay. Used cars. It was noted during the count that inventory levels of used cars had increased significantly, despite being no increased sale in the sales volume of either new or used cars. The valuation of used cars was not performed during the count. However, the audit supervisor did note that some of the cars held at one location did not appear to be saleable condition due to the damage while held at the car showroom site. So obsolete stock, damaged inventory. So the inventory value is a big risk here. Okay, the inventory values are increasing. There's obsolete stock. Since 5 cars, the parts are present. Used cars are damaged. So those are obviously the issues which we will be discussing when we will be referring this thing, that why the inventories of parts and pre-used cars have been identified as a significant risk. And then the last exhibit, which is in relation to sustainability reporting. I hope you all remember we have a complete article in relation to sustainability reporting, which we have covered in our course lectures. Calibrate companies to include additional information within the year's annual report, which demonstrate the sustainability targets and the achievement of the company. Your firm has been approached by the directors of Calibrate Company to determine appropriate sustainability key performance indicators in this area. Calibrate Company also requires assistance from Owais Associate to establish the systems to capture and measure the sustainability information. The directors require a separate assurance report on these KPIs, which they have asked Owais Associate to provide. First of all, we are auditor. They are asking us to provide non-audit services. Not only for the assurance, but they are also asking us to assist them in establishing the system. And then they are asking us to provide the assurance report also. So there are a lot of ethical issues which you have to refer in the last requirement where we have to use the exhibit 4. Okay, so we have just read all of the exhibits. That's just the initial reading of the question, which is very important that you read the question for the first time, you identify the data. Okay, we'll obviously go in detail when we will be drafting the answer. Respond to the instructions in the email from the partner, 40 marks. You have all looked at these instructions, the 40 marks. And then the split of allocation is shown in Exhibit 1, we know. Professional marks will be awarded for demonstration of skill in communication, the format of the meeting notes, headings, proper wording, analysis, analyzing, auditing and accounting rules, evaluation relating to the scenario, professional skepticism, questioning the data, judgments in relation to materiality, misstatement, commercial acumen, which you demonstrate while writing the business risk, your practical perspective. So 10 marks are professional skill marks, which will obviously be demonstrated while you'll be drafting the answer, the complete answer. So we'll be looking at these technical marks and also at the professional skill marks as we draft the answer. So we have just read the question for the first time. The same approach will be followed in the examination. The same approach will be followed in the examination when you'll first read the question with patience, with concentration, relax, pick up the maximum data, and then you will go in detail of each of the part. Okay, I'm actually doing what you will have to be doing in the examination. Okay, so it's the question is Owais Associates. Your firm is Owais Associates. The client is Calibrate Company. Okay, so Owais Associates. This is your question. Now, you have to respond to the instructions of the email from the audit engagement partner. Okay, so what you have to prepare briefing notes. Okay, now since there are marks in relation to professional skills, so you need to make sure that you make a proper format of the briefing notes. you give proper heading, and you follow the proper approach. Okay, otherwise you will be losing the marks. So you have to make sure that you follow all the approach. So how you have to make the format of the briefing notes, how you have to write the introduction paragraph and all. Let's look at that. Okay, that simple, easy routine. We have done it in the previous revision sessions also. I will repeat it in this also, that how you have to deal with it. Let's look at it. Okay, so now when we talk about the format of the briefing notes, it's very simple. You pick up the data from the partner's email, you copy this data, okay? Just understand that how we have to make this format, and you paste it here, okay? You break up the lines, okay? This subject and this date. Now, what you have to do is that since you are replying, so you will switch the from and to tabs. I will cut this and I will paste this here. And I will cut this audit manager from here and I will paste it here. And in subject, I will add RE for reply. See, it's very simple. Just learn the drafting approach. That's very important for the actual examination. You pick up the data from the partner's email, to, from, subject, and date. You paste it on your answer. You switch to and from since you are replying back. Okay. And in the subject, you add RE for reply, and then comes the date. Now you have to give an introduction. In briefing notes in advanced audit and assurance, you have to give this introduction. Now, how this introduction is made, it's very simple. These briefing notes are in relation to audit planning for, see, these are standard things. You just need to refer the client name. The client name is Calibri Company. For Calibri Company, for the year ended, okay, refer the year end, for the year ended, for the year ended. What is the year end? The year end is 30th September 20x5. For the year ended 30th September 20x5. Okay. Now you have to refer each of the requirements. Basically, this is the introduction of the briefing notes, and you will be getting the marks of communication skill when you make this format. In these briefing notes, business risk relating to Calibri Company audit are evaluated along with, see, you have to refer each of the requirements. In these briefing notes, business risk relating to Calibri Company audit are evaluated along with evaluation and prioritization of significant risk of material misstatement to be considered in developing the audit strategy and audit plan. You are just referring each of the requirement. You can copy and paste the things also along with evaluation and prioritization of the significant risk of material misstatement to be considered in developing the audit strategy and audit plan. Okay, so you're just wrapping each of the requirements. These briefing notes are in relation to audit planning for Calibri Company. You refer the year end. In these briefing notes, significant business risk in relation to Calibri Company audit are evaluated along with evaluation and prioritization of significant risk of material misstatement to be considered in the audit strategy and audit plan. What's the third requirement? Okay, justify why the inventory of parts and pre-used cars have been identified as risk of material misstatement. So you have to give the justifications in relation to it. So again, you can copy it from here. Further justifications of considering, okay, inventories of parts and pre-used cars as a significant risk of material misstatement are also included in these briefing notes. Okay, see, you need to keep it very simple. Don't spend too much time in drafting it. You just need to refer each of the requirements. Further justifications of considering inventories of parts and pre-used cars as a significant risk of material misstatement are also considered or included in these briefing notes. Then principal audit procedures are included. Okay, principal audit procedures in relation to be performed on the valuation of the used cars used car inventory are also part of these briefing notes. Lastly, what is the last requirement if you go and look at it? Lastly, the ethical and professional issues arising from the director's request for Tehama Associate to provide the system of sustainability reporting. Okay. And what type of services we can provide. So you can summarize it up. Lastly, ethical and professional issues arising from request of directors of Calibri Company in relation to sustainability reporting and assurance, along with permitted services evaluation, is also included in these briefing notes. Okay, so what you need to understand is that in question number one, where there are marks of communication skill, you have to make this format. To, from, subject and date, that you pick up from the partner email. You switch the to and from tab. In the subject, you add RE for reply. The date was given in the partner's email. Now, in the introduction, you refer the name of the company, you refer the year. Then you have to refer each of the requirements. Please make sure that you don't spend too much time. Obviously, I was guiding that how you have to write it. That's why we took 2-3 minutes. But in actual, it will be like in a minute, you just pick up the requirements, you refer them briefly. Okay, it just need to be a normal introduction, nothing addition. Just refer each of the requirement. In these briefing notes, business risk in relation to Calibri company audit are evaluated along with evaluation and prioritization of significant risk of material misstatement to be considered. Further justification of considering inventory of parts in pre-used cars as a significant risk of material misstatement are also included in these briefing notes. Principal audit procedures to be performed on valuation of used cars are also part. Lastly, ethical and professional issues arising from the request of directors in relation to sustainability reporting and assurance, along with permitted services evaluation. Because in the last part, it was asked that what type of services we could actually provide. So you referred each of the requirement while developing this introduction. I hope that you guys are getting it. Now comes the first requirement, which is business risks. Okay, this is your first requirement, which you have to develop. Okay, now you will write each of the business risks, each business risk worth 2 marks. You have to attempt for 10 marks. So you have to draft 5 risks in actual. So you'll pick up each of the business risks. Your approach is that for every risk, you identify the risk, you comment on its impact, that what impact it is creating, and then you comment on the scale, on the intensity of the risk, that why that risk is a significant risk. Okay, you comment on the identification, that what risk exists, you identify that risk, you comment on its impact, and then you comment on its significance or intensity, that why that risk is becoming a significant risk, a big concern for the company. Okay, let's look at it. While I'll be drafting the business risk, you will be able to understand that how you have to use with it. And while doing this, you have to use all of the exhibits. In part B, you had to use exhibit 2 and 3. In part C, you had to use exhibit 4 only. But in business risk, you were free to use all of the exhibits. Using all of the exhibits, evaluate the significant business risk. Okay, so if we go to the exhibit 2, which was company information, because exhibit 1 was only the partner email. If you go to exhibit 2, the important business risk was in relation to cancellation, the risk of cancellation of the Perpetua Car Company franchise agreement, for which we pay an upfront fees of $800,000. And secondly, if the lease agreement gets cancelled, we had to pay the penalty. If you remember that early payment penalty also, it was written somewhere. If you remember, first of all, when it gets cancelled, we don't get any refund. And yes, if the franchise is withdrawn, then Calibri company will pay the penalty to exit the property lease early. So the most important risk from there is the risk of Perpetua company cancelling the lease agreements. Okay, and which happened actually also during the year when in the meeting note it was written that we lost one of the franchise agreement. Okay, so the first risk which you can write is risk of cancellation of perpetua company lease or franchise agreement. And when they cancel the franchise agreement, what happens is that they even don't refund you the franchise fees which you have paid. And most importantly, when the agreement gets cancelled, since the location that showroom belongs to Perpetua Car Company, what they do is that they also import the exit, the property lease early penalty also, which applied on us during the year of $350,000 when they just canceled the lease agreement. And that is completely in their hands to cancel the lease. It's not in our hands, they determine it. And the basis for the cancellation can be that we failed to meet the sales target, which was written here. If you remember that the sales volume indicators and the updation of the fixtures and fitting. See, obviously, updation of fixtures and fitting is something which can be done. But when you talk about the sales volume targets, it is something which depends on the economic situation also. It also depends on the Perpetua car company making the cars, that how quality cars they are making. And considering that they are in the industry of electric cars, so which is the future of the car industry. For 3 years they don't have that thing in mind, so the major concern is that maybe Perpetua car company sales start to decline, not because of us, because of them only. And as a result, we will lose the franchise agreement and our the fees of $800,000 which we have paid and the penalty which will get applicable. So that all is a big concern for us. Okay, so risk of cancellation of the lease agreement, that is the first risk which we need to consider. So Calibri company may face a loss in form of franchise fees paid and a penalty of early lease cancellation if Perpetua Car Company Perpetua Company cancels its franchise agreement. Okay, now this is the risk that we will face this issue. Okay, we may face a loss of franchise fees paid, we may face the penalty of early lease cancellation if Perpetua Company cancels its franchise agreement. Okay, Perpetua Company may cancel the franchise agreement if Calibri Company fails to meet the sales targets, which may not be in control of Calibri Company always, if due to bad economic conditions or due to decline in popularity of Perpetua Company cars, Calibri Company may face cancellation of franchise rights. This will result in loss of business along with wastage of heavy franchise fees paid. Okay, this risk materialized during the year when one of the franchise rights were notified to be cancelled within 3 years of getting those rights. Okay, along with penalty of early lease termination, Calibri companies lost in case of cancellation of franchise rights increases. Okay, so one of the important risks for us is from the perspective when Perpetua company cancel the franchise rights, which are not always in our control. Calibri company may face a loss in form of franchise fees paid and a penalty of early lease cancellation if Perpetua company cancels its franchise agreement. This is the risk. Now, Perpetua company may cancel the franchise agreement if Calibri company fails to meet the sales target, which may not be in control of Calibri company always. If due to bad economic condition or due to decline in popularity of Perpetua company cars, Calibri company may face cancellation of franchise rights. This will result in loss of business along with wastage of heavy franchise fees paid of $800,000. And this risk actually happened during the year when franchise rights were notified to be cancelled within 3 years of getting those rights. On one of the location, this happened when your franchise rights got cancelled on one of the location. Okay, along with penalty of early lease termination, Calibri company loss in case of cancellation of franchise rights increases because it's not just the franchise rights which you are losing because the location that showroom belongs to Perpetua. They impose early lease termination also. Okay, so due to penalty of early lease termination, Calibri company loss in case of cancellation also increases. Okay, so this risk has materialized during the year when one of the franchise rights were notified to be cancelled. So see, many students have this concern that sir, we face difficulty in drafting the business risk. While drafting the business risk, what you need to keep in your mind is that you cover three things. Not necessarily that you cover it in sequence. You cover three things. Identify the risk, that what the risk is. The risk was that your license will get cancelled and your fees paid will get wasted. What's the impact? The impact is that you are losing the business, the early termination risk, the penalty of the early lease termination, that all is the impact. Is this risk a significant risk? Yes, this happened during the year. It happened during the year. It became a significant risk. Okay, like it's not something which we are thinking which may not happen. This has actually happened. This loss has actually occurred. Okay, so the first business risk in relation to Calibri company was in relation to a risk that the license agreement may get cancelled, which actually happened during this year. Okay, then there were issues relating to servicing repair also where we have to keep heavy inventories. And if you remember in the exhibit number 4, there was a complete detail that the inventories were getting piled up. Our inventories have increased a lot, like 480 to 580, the parts have increased. So if you look at the increase, the percentage increase, the parts inventory have increased by 20%. Okay, and used car inventory has increased by 30%. So your inventories are getting piled up, and you just got a notice that out of 8 franchises, you are losing one of the franchise. So this increased inventory is in reality a loss. The things are getting obsolete. Okay. Inventory losses. Okay. Now, parts and used cars inventory have increased by 20% in part head and 30% in used cars head, which indicate a risk of obsolete and damaged inventory getting piled up. Okay, if inventory includes obsolete and damaged items, then it is a loss to profits which Calibri company is facing. Okay, it is tying up big amounts in its inventory which is getting piled up, and it may lead to cash flow concerns also. Like you have useless items in your inventory, now you are buying more items. So that will automatically lead to cash flow concerns. Okay, just a second. Number of used cars sold have not increased during the year and inventory is increasing. Okay, it was written here in the exhibit number 4, if you remember, that it was noted that despite that, there was no increase in the sales volume of either new or used cars. So you're just getting piled up things. Okay, your parts inventory has increased by 20%. It was an increase of 100,000. So if you divide it by 480, it was an increase of 20.8%. And then on the used cars, it was an increase of 30, which we wrote. Okay, for the calculation of these increases, you get zero point 0.5 mark extra. Okay, now is this risk a significant risk? So you can say that you lost one of the showroom, just out of 8 showrooms, you lost one of the showroom. So obviously, these used cars and the parts, they will be actually used less. Okay, in current year, Calibri company has lost one of the franchise right out of 8 rights which it holds, which indicates that there will be lesser demand of parts and used cars in coming years. So that is the actual loss which you will be facing. Sooner or later you have to book a write-off of the inventory. Okay, like it's not like that you can always keep it in the books. Even in the ROMM, we will write that they have a concern that they need to look their inventory for the review of lower of cost per NR. So the inventory losses is one of the risks which they are facing. So you first identify the risk that, okay, this risk exists. Then you explain the impact that, okay, that will lead to decline in the profits, that will lead to cash flow concerns because the inventory is getting piled up. And you give a reason that why that particular risk is a significant risk for them. Okay, so we wrote a risk in relation to this thing, that the risk of license cancellation. We wrote a risk in relation to the parts because they have to keep large amounts of car parts and inventory to enable them to repair. Okay, now if you remember, there was one issue that there's 70% of the sales represent the sale of new cars. See, when your 70% sale depends on new cars, you are always exposed to economic conditions. If due to changes in the economic conditions, people reduce their buying of new cars, your revenue will take a hit. Okay, your dependency on used car segment is very less. Then, considering that the electric car segment Perpetua is not present in them. So, due to the wrong strategies of Perpetua, Calibri company will be taking a direct hit. Okay, so dependency on new car sales. Okay, Calibri company faces the risk due of changes in economic conditions, as if economic conditions gets worsened, then people will reduce buying of new cars, which represent 70% of Calibri company sales. Okay, used car sales is a small proportion of Calibri company sales, which would have been an important segment in times of economic recession. Okay, that's a very important segment. Okay, decline in sales will not only affect Calibri company profits, but it will also affect the renewal of franchise agreements, because their franchise agreement renewals are dependent on meeting the sale targets. Okay, so obviously that's a big concern, that their dependency is on the new car sales segment only. Okay, considering that sales of new car have not increased in the current year, This is a significant risk that maybe economic activity is getting slowed down. Okay, because if you remember, it was written in the inventory had that there being no increase in sales volume of either new or used cars. So this indicates that the things are getting slower. The things are getting slower, and when the things are getting slower, it's a concern. It's a concern. Maybe the economy gets slowed down, and since used cars do not represent your major revenue, people don't consider you as a used car seller. So obviously, that will be a risk. Then they have no presence in electric car, and a new electric car will be released in 20X8. And in the recent world, it's a changing trend that electric cars are taking over. Okay, lack of presence in electric car segment. Okay, sales of perpetua cars may decline due to change in trend towards electric cars, and perpetua cars do not have electric cars currently and for next 3 years. This is a risk for Calibri company, as under franchise agreements they cannot sell other company cars. Okay, we are bound under the franchise agreement with Perpetua only, and Perpetua cars do not have the electric cars currently. Okay, sales of new cars have become constant in the previous year, which indicates a shift of trend of people towards electric cars. If that is happening, or if that is the reason of sales getting constant, then in next 3 years, till Perpetua Cars launches its electric cars, Calibri company will suffer as its franchisee. Okay, so we referred the constant sales because the sales have lost the increasing trend. Now, someone can argue that some revenue is still increasing, but the increase in revenue may be due to repair work also. Okay, now we are referring the constant sales of new cars because it was written here that the sale volume have remained same, maybe to economic recession or maybe due to the shift of trend of people due to towards the electric cars. Okay, now after 3 years, when Perpetua Cars launches its electric cars, maybe it is late in that segment, as new companies, as other companies may have established themselves in that segment. Like, for example, if you look at it practically also, the oldest car manufacturers were Toyota, Honda, BMW, Audi, Mercedes. But Tesla, which was very young in front of them, like only 10 years, 15 years old company, came with the idea of electric car, and now today the most valuable automobile company is Tesla. Now those companies which are very old, they were only late in the electric car segment. So same will happen with Perpetua cars if they are late in this segment. Okay, so lack of presence in electric car segment is also one of the risks which exist here. So risk of cancellation of license, inventory losses, dependency on new car sales, lack of presence in electric car segment, obviously due to Perpetua's wrong policies, we will be suffering because we are their sole franchisee and we have the 8 franchises. Loss of franchise location, we already referred it in the risk thing. Okay. Now the potential future listing. Here there is also business risk that the timing of the listing is not good. You just lost one of the franchise agreement and you have very weak governance structures as of today. So if you will go for listing, maybe you will not be able to attract good investment, or maybe it will just increase your compliance score. And there is a risk of penalties being faced from the regulator, because once you get listed, there will be stringent requirements in relation to audit committee, in relation to internal audit, and the things will get serious. Okay, so potential future listing. Calibri companies plan to get listed in next 6 months exposes it to a risk of increased compliance cost and risk of penalties getting imposed. Okay, currently governance structures of Calibri company are weak, as they don't have an internal audit department and a proper audit committee and a proper audit committee proper audit committee. If they go for listing, if they go for listing, these compliance requirements will increase its cost, and if it fails to comply, then penalties may arise. Further, timing of Calibri company listing are also not favorable, as recently it has faced a license cancellation of Perpetua company, and if with this situation it will go for listing, it may not be able to attract good investment in share issue. Okay, obviously, when you go for listing, what you need to understand is that that should be best of your times, not the bad times. Because what's the objective of listing? To raise investment. So you just got a license cancellation and you are going for listing in these times. So maybe you don't get a good share issue and your compliance cost gets increased. So this listing would be a pure burden for you guys. So the business risk which we had to discuss, there were 10 mark risk questions. So we had to write 5 risks. Risk of cancellation of license, which actually happened during the year. Inventory losses was a risk which they were facing, okay, that the inventory is getting piled up. Dependency on new car sale, which expose you to economic conditions. Lack of presence in electric car segment, potential future listing. Okay, so these were the business risks which they were facing. Okay, so you had to write 5 risks here. In that regard, you wrote those risks. Okay, it was a bit tight question for business risk, and normally picking up these risks require a good commercial acumen. Okay, that you have to be very careful while picking up the risk, because it's about looking at the things from the practical perspective. Now, if you look at the next requirement, it's in relation to risk of material misstatement, which is a requirement for 12 marks. Okay. Now, when you talk about risk of material misstatement, you have to write a paragraph in relation to materiality, which holds up to 2 marks. Okay. And then you have to write the risk, in which there can be accounting risk. The accounting risk can hold up to 3 marks each. If you perform the financial analysis, the ratio calculation. So for each ratio, you get up to 0.5 marks. Maximum that can be 3 marks. You make commentary on that. So you already know these guidelines, the marking guidelines, that for what thing, how many marks are available. Okay, so let's look at risks of material misstatement, which is our requirement B. Okay, Now, first of all, we will write a paragraph on materiality, because whenever you are writing ROMM or audit risk, you always have to include a paragraph on materiality. Okay. Now, this is again a standard paragraph for materiality. Now, materiality for Calibri company audit will be based on benchmark of profit before tax. It was instructed in the question that you have to base it on profit before tax. It's not our choice. It was stated that you have to use the profit before tax as a benchmark. Okay. Now, materiality threshold of materiality based on profit before tax is 5% to 10% of profit before tax, which in case of Calibri company, will be, now what is the profit before tax? If you look in the meeting notes, your profit before tax is 19.3 million, 19354,000. So 10% of the PBT and 5%, that's the range. And that's given by what? That's given by the auditing standards. There are three benchmarks of materiality: revenue, PBT, and asset. Now, in profit before tax, the range of materiality is 5% to 10% of PBT. Okay, so 19.354 million is your profit before tax. So 10% will be 1.9 million and 5% will be 0.95 million, will be between $950,000 to $1.9 million. Okay, like calculating this materiality level also hold 0.5 mark each. It's 5% to 10% of PBT. So it's 19 million, okay, 19,354, and it's in thousands. So 10% will be 1.9 million and 5% will be $950,000. Okay, our firm will have to use professional judgment to determine materiality level from this range based on risk assessment of Calibri company audit. See, now these are the standard statements which you have to use. Okay, that we'll be using our judgment to determine the materiality level. Okay, I hope you are getting it. Now, what will be your judgment here? Now, if you look at the question, Calibri company is an existing audit client. It is never written that it's a new audit client. It was not written anywhere that we are just appointed. You need to start planning to help. I'm providing you the information. All the information indicates that it's your existing client. Even in the introduction also, if you can look at the introduction, where it's normally written if it's a new client. You are a manager in Tohoma Associate, responsible for the audit. Nowhere it's written that it's a new client. So it's an existing audit client from this perspective. Okay. Now it's an unlisted entity currently, but they are planning to get it listed in the next 6 months. And it was written, I hope, in the meeting notes that the directors have a strong pressure to show good performance. So despite that it is an existing audit client, I will consider it as a high risk audit, because they are planning to get listed in next 6 months, and that is the most significant thing which can increase the risk here. Okay, despite that Calibri company is an existing audit client of our firm, risk of audit will be considered as higher, as Calibri company is planning to get listed in next 6 months, and directors have a pressure to report good performance. Okay, risk of manipulation in accounts will be higher. Okay, will be higher. Considering higher risk of audit, lower threshold of materiality will be selected of $950,000. Let me repeat it again. Let me repeat it again. See, materiality for Calibri company audit will be based on benchmark of profit before tax. Okay? Because it was instructed in the question. Materiality will be 5% to 10% of PBT. Okay, and you calculated its values. Okay. Now, if you want to be exact, it's 19,354, 19354. So its 10% will be 1.93 million. Okay, so if you want, you can be exact also, you can do round off also, that's also acceptable. And 5% would be around, like, if you divide it by 2, it's around 967,000. So you can do that round off, that's permitted. Or if you want to be exact, that is also acceptable. So don't take any stress. Our firm will have to use professional judgment to determine materiality level from this range. Now, if it would be a new client, it would be high risk, but it's an existing client. It was nowhere written that it's a new client. The most important thing which increased the risk of audit here was that they were planning to get listed. And that listing planning increases the incentive, the pressure on the directors to manipulate the accounts. And that increases the risk. And when the risk increases, you have to go for a lower threshold of materiality. Okay, considering high risk of audit, lower threshold of materiality will be selected. Done. When the materiality level gets reduced, automatically there will be a more detailed audit getting done. There will be a more detailed audit. So, materiality benchmark, threshold, calculation, judgment. For this paragraph, you will get 2 marks on the overall paragraph. These ranges which you calculated, you will get 0.5 mark each. So 2 plus 1, lower and upper range, 3 marks. And you took the judgment of the materiality, you will get a professional skill marks of judgment also. You followed the instruction of the examiner, you will get a mark in communication skill also. So this one paragraph of materiality in itself hold more than 4 marks. Sir, how 4 marks? 2 marks of this entire paragraph. 0.5 mark each for these upper and lower range. 1 mark in the judgment skill. You selected the materiality level. And then communication skill also, because he followed the instruction of the exam. But I always say that be on the conservative side. Only consider that it will gain you 2 marks in the technical. Like professional skill are separate, that is on the overall. But in the technical, it will gain you 3 marks, up to 3 marks. But I always say that while drafting your own answer in the examination, be conservative on marking so that you write few extra points also. So that even if you lose some marks in any point, that additional point will cover your marks. Okay. So this risk of material misstatement is of 12 marks. You can say that, okay, 2 marks are done for the materiality. Okay. Now you will discuss each of the risks, you will draft it, and you will be getting the marks. Okay. The first risk in itself was the pressure on the directors. The pressure on the director on itself was a risk. The weak internal audit department. In order to improve the company recently hired a new qualified accountant with experience in audit. The company aims to create an internal audit. So this means they don't have an audit as at today. Okay, so that itself is a risk of material misstatement when you don't have an audit department. Then the cancellation of license. They didn't made any adjustment. At least you need to write off this $800,000. You need to make a provision for the penalty which will be imposed on you. Okay. And if you remember, if you go in the previous thing, they are considering these licenses as indefinite life. How they can be indefinite life? Okay. You have to review them for impairment every year because the franchises which are not meeting the sales target, they need to be reviewed for impairment every year. Okay. So if I just make a list, okay, pressure on directors to report good performance, that is a risk. Then cancellation of lease agreement, then lack of internal audit, or you can say weak governance structures. That is a risk. Okay, then you can write a risk in relation to what we can say the intangible asset. The intangible asset, the franchise right, which they book for indefinite life. Then there can be a good financial analysis. So how many marks? It's a question worth 12 marks. Okay, so very conservative. 2 marks for materiality, Pressure on directors is a general risk, so you can keep 2 marks for that. Cancellation of lease agreement is an accounting risk, so you can get 3 marks for it. Lack of internal audit, you can get 2 marks for it, because again, it was a general risk, not an accounting issue. Intangible asset is a risk of 3 marks. See, the accounting issue can get up to 3 marks, and the normal one get 2 marks. So 2 plus 2, 4, plus 3, 7, plus 2, 9, plus 3, 12. Very easy. I didn't went in those small details. I didn't went in that. I just picked up the risk in overview. Financial analysis can be a very good risk. You can do a good financial analysis, growth in revenue, profit before tax. Okay, that all analysis, because obviously the changes in the profit margin and everything, that also gain marks. But the big risk. Okay, so these are the big risks which you can write. Pressure on the directors due to the listing thing, cancellation of the lease agreement, because that will lead to the impairment of the lease right of that. And secondly, the most important thing is that they need to book a provision for the penalty which will be imposed, because they have already been notified that they are cancelling the lease right. Okay, then the intangible asset thing. Okay, so let's start drafting the risk. Now, see, this is not an accounting risk. This is a general risk which creates an exposure to manipulation. Directors of Calibri Company, because it's written here itself that the board of directors are keen to ensure the financial statements show a strong performance of the year. Directors of Calibri Company have a pressure to report strong performance, considering their plans to list Calibri Company in next 6 months. This will lead to a significant risk of manipulation in their accounts, considering loss of one of the franchise agreement also. Actual performance of Calibri Company will not be very good. Okay, this can also be seen, this can also be observed from the fact that finance director did not record impairment and provision in relation to recently terminated franchise agreement by Perpetua Cars Company. Okay, when the franchise agreement has got cancelled, you have been notified. When you have been notified, so the point is that you need to think about the impairment thing. You need to think about recording the provision. Okay, so you have got the notification for the cancellation. The Calibri Company obtained the franchise rights on 1st October 20X2. You have been notified that you are losing the license agreement and you are not recording impairment. You haven't done any adjustment in relation to it. So at least this $800,000 need to be paid. And if you will record an impairment of $800,000, you will record a penalty of $350,000. Your growth and profit before tax will almost be lost. So directors of Calibri Company have a pressure to report strong performance considering their plans to list Calibri Company in next 6 months. This will lead to a significant risk of manipulation in their accounts. Considering loss of one of the franchise agreement also, actual performance will not be very good. This can also be observed from the fact that finance director did not record impairment and provision in relation to recently terminated franchise agreement by Perpetua Cars Company. Strong financial performance will be very important for successful listing of Calibri Company, as otherwise they will not be able to attract investment on initial share issue. Okay, so this is the risk which they are facing. Now, this is not an accounting risk like an IS or IFRS risk. This is a general risk. See, if you remember the risk of material misstatement when I taught, there are different types of risks which are included in our. There are accounting standard risks like cancellation of lease agreement. There is an accounting standard risk, IS 36 impairment, IS 37 provisioning. Then intangible asset, which they are recording at indefinite life, that is an issue of IS 38, intangible asset. Those are accounting standard risks. Those hold 3 marks each. But when you talk about these risks, where you are talking about the general issues like weak governance, pressure on the directors, these are what we call as the general risk. They hold up to 2 marks. Okay. Now, cancellation of lease agreement. Calibri company need to record impairment in relation to lease rights or franchise rights for which Perpetua Cars Company has notified it for cancellation. Okay, you need to record the impairment in relation to franchise rights. Franchise fees is non-refundable and it will get wasted as per the franchise agreement. Therefore, impairment need to be recorded. So this is the correct accounting treatment which should happen. Further, a provision for early lease termination penalty of $350,000 also need to be recorded, because as per agreement, when franchise gets terminated, Calibri company will have to vacate showroom of Perpetua Cars by paying exit penalty. So this is what need to be done. Further, impairment in relation to assets included in showroom also need to be considered, as Calibri company may not be able to use all of them in other branches. Okay, so this is what need to be done. This is what we call as the correct. Now, what they have done, finance director of Calibri company has not done any adjustment in relation to lost franchise rights. This will result in overstatement of assets and profits of Calibri company. Okay, adjustment required in relation to franchise rights and penalty provision worth how much? I think $50,000 if I'm not wrong. If you can go and look at it also, it was $800,000 plus $350,000. So it's 1.15 million. Okay, worth 1150,000 exceeds materiality level of $950,000 for Calibri company audit. Therefore, material to financial statements. See, this risk worth 3 marks because it was relating to accounting. You wrote the correct treatment. You wrote the correct treatment. You commented on what management has done. Management has not done any adjustment. You referred the heads affected that what is getting overstated, and then you comment on materiality. First was the materiality paragraph. Then pressure on director wasn't any accounting standard issue. It was a general thing. It was stated in the question. Cancellation of lease agreement was an accounting issue. Okay. Sir, are we required to give reference of IAS and IFRS numbers? No, it's not required. You're not required to give reference of IAS and IFRS number. You just need to refer the correct treatment. That, okay, impairment need to be considered, this need to be considered. You just need to refer the correct treatment. The examiner is not interested in IAS, IFRS or ISAN. You can go and refer the marking schemes also. In the marking schemes, there are never IAS and IFRS. Yes, in the examiner's suggested answer, he write the numbers. But that is just a suggested answer. There is a marking scheme at the end of every paper that for what the marks are available. In the marking scheme, there are never numbers for IAS and IFRS. The numbers are for explaining the correct treatment, explaining the relevant IAS. Okay? Now, then there is the risk of lack of internal audit, or if you want, you can write it as weak governance also. Lack of internal audit or weak governance, and then there is an issue relating to intangible asset. So that will complete your 12 marks of this question. Okay, so let's look at it. Let's graph these two risks also, and then our risk of material misstatement will be done. Okay. Okay, so in relation to lack of internal audit, if you remember, in the meeting notes, it was written that the company aims to create an internal audit department. So currently, they don't have an internal audit. And secondly, they may create an audit committee. So these two things indicate that currently the governance structures are not very good. Okay, Calibri company do not have an internal audit department currently, which creates a risk that systems and controls may not be operating appropriately. Okay, because when there is internal auditor, they highlight those things, and those guidelines help the company to improve their systems and controls. Okay, further, they also lack an audit committee currently, and non-executive directors appointed also lack a financial reporting expert among them. Weak controls and systems may lead to misstatements existing in financial statements of Calibri company. Okay, governance and oversight structures of Calibri company are weak. As a result, controls and systems are exposed to risk of manipulation and errors. See, what you need to understand is that when there is an audit committee, a non-executive director with financial reporting expertise, they act as an oversight, they act as a governance tool, which makes sure that the things aren't manipulated. Okay, so they don't have an internal audit, the governance structures are also weak. And then there is a last accounting risk in relation to intangible asset, where they stated that they assume that the license fees which they are paying has indefinite life. And if it has an indefinite life, then it need to be reviewed for impairment every year. Its life estimation need to be done every year. And considering the franchises which are not performing well, the licenses may get withdrawn. So in that case, the life may become definite, the life may become finite. Okay. So license fees paid by Calibri company is recorded as an intangible asset with indefinite life. As per accounting standard, assets with indefinite life should be reviewed for impairment every year, and their life estimation should be tried at each year end. You have to try to estimate life at each year end, and along with that, you also need to do the impairment testing. Okay, in case of Calibri company, life of licenses may become definite if the franchise is not able to perform well, and it is expected that its license may get withdrawn in near future. It may also act as an impairment indicator. Okay, so this is what need to be done as per the accounting standard. That okay, if you are saying that they have indefinite life, then you need to do impairment testing every year. You need to attempt to estimate life every year. You cannot leave it like that. Okay, and when the franchise is not performing well and it's expected that okay, the license will get cancelled in 2 years, in 3 years, then the life becomes definite, and also it's an indicator of impairment. Apparently, management of Calibri company is not performing impairment testing and life estimation every year. Okay, this may overstate profits and intangible asset of franchise fees paid. Okay, franchise fees paid worth how much? $800,000 multiplied by 8 licenses, because they had 8 franchises. So I believe that it will be $6.4 million. Exceeds materiality level of Calibri company audit of $950,000. Therefore, material to financial statements. Okay, so if you look at it, 2 marks for the materiality paragraph, then 2 marks on the pressure on director because they have an incentive to manipulate the books. Cancellation of lease agreement, which has got cancelled, or you can say the franchise agreement. Okay, a 3 marks accounting standard risk. Then in relation to lack of internal audit and intangible asset. Okay, now since it's a question of risk of material misstatement, so you need to write a conclusion also to justify your prioritization. Now, if I look at the significant risk here, I believe that pressure on the directors to manipulate the accounts is the most significant risk. The reason being is that they are planning to go listed in next 6 months. Okay, so that is the most significant risk. Cancellation of franchise agreement is $1.1 million. Then there's lack of internal audit, and then there's a risk in relation to intangible asset. I believe that intangible asset is also a big risk because it's worth $6.4 million. So I will paste it here after the pressure on directors. And then I will put weak governance also as an important risk, because that's particularly important that the company has very weak governance structures. And cancellation of lease agreement barely exceed the materiality level of $950,000. Okay. Pressure on directors to report strong performance despite of loss of franchise agreement. Loss of franchise agreement is most significant risk of material misstatement for Calibri company audit. Okay, then impairment of intangible assets of franchise license and life estimation every year is second most significant risk, as it represents ahead of $6.4 million. Lastly, weak governance structures, weak governance and lack of internal audit is also one of the significant risks of material misstatement. See, the objective of writing conclusion is not to conclude your answer. The objective is that you have to give the reasoning of your prioritization. Okay, I'm removing these marking guidelines because these were just for your guidance. I will repeat the things again also, so your patience would be particularly important. Just listen to me carefully. Now, so if you look at this answer of risk of material misstatement, which was of 12 marks, we started with a materiality paragraph. Then pressure on directors to report good performance was one of the significant risks because they were getting listed in next 6 months. Okay. Then intangible asset head, where they were following indefinite life, was one of the area of judgment, and they need to check impairment and life estimation every year. Lack of internal audit and governance, and the cancellation of franchise agreement. The cancellation of franchise agreement, I didn't consider it in the top three risks because it worth $1.1 million maximum hit, and our materiality level was $950,000. So these were the three most significant risks, and I gave the reasoning that, okay, this is the first one, this is second, and this is third. So the conclusion is not the conclusion of the question, it is just the reasoning of the prioritization. So can we do the financial analysis point here? Yes, you can do. But since our 12 marks were completed, 2 marks for materiality, 2 marks for pressure for director, 4, 3 marks for intangible assets, 7, 2 marks for internal audit, 9, and 3 marks for cancellation of franchise agreement. Accounting standard points score up to 3 marks. Since our 12 marks were completed, so I didn't do the financial analysis. But if someone would have done, that would have been acceptable. Okay. Now let's look at part C, where we have to give justifications that why inventory is being considered as a significant risk. Okay, we were not required to refer the inventory in the part B because it's separately dealt in part C. And then we have to refer the principal procedures. It's a 10 marks requirement, so you can equally split also, or you can also do like you write 4 here and you write 6 procedures. Like it's not necessary that you always split it equally. It's completely open, so there is no issue in it. So part C1, justifications of considering inventory of parts and used cars as a significant risk of material misstatement. Okay, so we have to give the justifications why inventory of parts and used cars was considered as a significant risk, and then we have to write the procedures. And here we only have to use the Exhibit 4. So if you look at Exhibit 4, I believe that there were multiple reasons. First of all, the inventory was increasing. Of the parts, it was increasing by 20%, and in used cars, it was increasing by 30%. We were ourselves calculated. So when there is an increase, automatically it's a risk. Then, if you remember, in the parts act, 5 different color sticker means that the sum of the parts were those which have been part of the inventory count for multiple times. So that creates a risk of obsolete stocking. Okay, that obviously creates a risk of obsolete stocking. Then in the used cars level have increased by 30% despite there is no increase in sale volume. Okay, some of the cars appear to be damaged also. They are not in saleable condition. And if you remember, they performed the count in the month of March, whereas the year end is 30th September. So even they are not performing the count at the year end. So when they are not performing the count at the year end and they are using the roll forward, like they are just picking up the values of purchase and sale to adjust the inventory value. So that obviously also creates a risk. So if you have to write 5 justification, each justification worth 1 mark. First justification would be that the count is not performed at the year end. It's performed in March, and then roll forward of the transactions is adjusted. Secondly, the parts inventory has increased by 20% and used car inventory has increased by 30%. So inventory levels are increasing. So obviously it has a risk of obsolescence. Number third, some of the parts have 5 colored stickers pasted on them, which indicates that some of the parts have been part of the count for 5 years continuously. Number 4, in the cars, the used car inventory is increasing despite the sales haven't increased. And lastly, some of the used cars included are even not in saleable condition. So this means that there are some damaged cars for which the valuation need to be performed also. Okay, so let's draft the justifications. Each justification worth 1 mark. You have to draft 5 justifications that why are you considering inventory as high risk. Okay, let's draft the answer. Okay, so the first justification of considering inventory of parts and used cars as a significant risk of material misstatement is that they are not performing the inventory count on year end. They are performing the inventory count on 31st of March, whereas the year end is 30th September. In order to arrive at the closing stock, they are doing the roll forward adjustments, which means that they are using their accounting records to adjust the sales and purchases. So if the accounting records are not well enough or the controls are not good, then as a result, there is a risk that closing stock value may not be the correct one. See, the objective of performing the physical count at year end is to match the physical inventory with the records, but they are not performing the physical count at the year end, which is a significant risk of material misstatement. Calibri company do not perform its annual stock count, on its year end of 30th September 20x5. Rather, it is performed on 31st March every year, and then roll forward adjustments are done in it to arrive at closing stock value. If controls and systems in inventory are not performing well, then roll forward adjustments may not give correct inventory value. See, basically what do you mean by roll forward adjustments? They use their accounting records to adjust the sales and purchases. So if your accounting records of inventory are not very well maintained or the controls are not very good, then using them won't be a good approach. Performing the annual stock count at the year end obviously is a big evidence that the inventory values are correct. So we have already reviewed the exhibit and we have already referred this risk. Then abnormal movements have happened in inventory of parts and used cars, as the inventory has increased by 20% for parts and 30% for used cars. This is an abnormal increase considering that one of the franchise of Calibri company has been closed during the year, okay, because its license was revoked. We are giving justifications, the reasonings that why we are considering inventory as a significant risk. So first of all, the count isn't being performed at year end, it is performed in March, whereas the year end is 30th September. Secondly, we refer the percentage increases. Then we look at the parts, so we can see that some of the parts have 5 different colored stickers, and every year we change the color of the sticker. Okay, the color of sticker is changed each year. So 5 different colored stickers indicates a risk of obsolete parts included in the inventory. So for those obsolete parts, you need to perform the lower of cost or NRV evaluation. Okay, parts inventory includes some inventory which is around 5 years old, as it has 5 different colored stickers pasted on it, where color of sticker is changed every year to highlight stock which existed previous year also. Okay, obsolete stock requires evaluation for its net realizable value, as its NRV may have fallen below its cost. Okay, so that net realizable value evaluation also has a risk, also increases the risk of making this inventory as a significant risk of material misstatement. So first of all, the count is not performed at the year end. Secondly, there is an abnormal increase. Third, some of the parts included are very old, they are getting obsolete. Okay, then as you look at the used cars stock, that is also increasing by 30%, despite there has been no increase in the sales volume. And most importantly, estimating the net realizable value of the used cars is particularly difficult because the used cars do not have a market like new cars, which have established selling price. Used cars is a judgmental area. Okay. Inventory of used cars has increased by 30% despite that sales volume of used cars have remained constant. Net realizable value of used cars also need to be evaluated as cars which are in stock for a long time may have faced a decline in value. Okay. Further, estimating net realizable value of used cars is itself a judgmental area as used cars may have difference of valuation from different buyer perspectives. Okay, like what you need to understand is that obviously used car do not have an absolute market. It's always that some buyer will come, maybe he'll buy expensive, maybe he'll buy cheaper. So it's not like the new cars. So its valuation itself is a judgmental area. And then you can say that, as indicated by the audit supervisor, that some of the cars were damaged and they were not in saleable condition. So again, for them, or it also need to be reviewed that maybe they need to be written off from the inventory. Okay. Audit supervisor highlighted that some of the used cars included in inventory were damaged and they were not in saleable condition. Cost to sell need to be incurred on them to sell them. This means that their net realizable value may have declined below cost, or maybe some of the cars need to be written off. Okay, so we were giving justifications that why we are considering inventory as a risk of material misstatement. These each justification worth 1 mark. It's not like a normal risk of material misstatement. We just need to give reasoning. Okay, so first of all, the stock count was not performed at the year end. There were abnormal increases. Parts inventory have some parts which are around 5 years old. Used car inventory has increased, and some of the cars are damaged also. So these are the justifications of considering inventory as high risk. Now we need to refer principal audit procedures to be performed on the valuation. See, the examiner has made it bold. Only talk about the valuation, on the valuation of the used car inventory. Okay, so now we need to refer the principal audit procedures on the valuation of the used car inventory. Okay, so now if you look at the used car thing, if you look at the used car, there are some cars, first of all, the inventory has increased. There are some cars which have been damaged. Okay. And from where we are getting these used cars, if you remember, if some detail was given in relation to it, okay, in this exhibit, wasn't enough detail, but I think for the used car, there was some detail. Yes. And make repairs to pre-used cars. I remember for the used car, there was a situation where we do the trade-in agreements. Okay, yes. Calibri company customers can part exchange their old cars and receive an allowance against the cost of new car. So basically, they are giving their old car as an exchange transaction. For example, I came and I said that, okay, this is my old car, give me a new car, and I'll pay this much difference. So how the purchase price of the used car is determined, that is also very important, because we are not directly purchasing the used cars. We are purchasing them as a trade-in. Okay. So first of all, you need to think about that. Then obviously you need to identify the cars which have been damaged. What cost to sell need to be incurred, because you need to just focus on the valuation thing. Okay. Then obviously you need to think about the net realizable value, that what is the estimated selling price of the cars. So you need to develop 5 procedures in relation to the valuation of the used cars. Okay, so let's look at the 5 procedures. Let's drop them one by one. Okay. Okay, so the first procedure which you can write here is, because you have to write the procedures for the valuation of used cars. Discuss with management that how they determine the trade-in value of used cars, like what is the methodology of determining the trade-in value. And for sample of transactions, check that whether trade-in value determined is correctly recorded in the inventory records as the purchase price of car. See, what you need to understand is that for used cars, they are not doing outright purchase. What they are doing is customer is bringing their old car. They say that, okay, this is the new car, we trade in, and the customer will pay the difference. So how they are determining the value of that trade-in car and whether that value is being recorded correctly or not. Now, obviously, when you are purchasing the used car, see, it's focused on used car. Whether the repair expenses, because obviously when you purchase the used car, you incur some repair outflows also. Whether the repair outflows are correctly recorded in the cost of car, then you can ask that, okay, let's verify the valuation of some of the cars through the market records, through some online records, that whether the used cars recorded at cost by the management matches the market value records or not. You can review some subsequent period events also, that in subsequent period the cars sold by the management are at more than the cost which they are recording, or it's creating a loss. Because if the car is getting sold at loss in the subsequent period, this indicates that net realizable value booked at the year end wasn't correct. Okay. Review market data to verify net realizable value estimates of management, as some of the cars may require a write down in their valuation if net realizable value has declined below cost. Okay, so the inventory which has been long standing, you need to look at their net realizable value also. Then what you can do is you can review subsequent events, review subsequent period transactions of the sale of used cars in order to verify that whether they are being sold at more than cost or not. If they are being sold, if they are being sold at less than cost, then maybe inventory write down needs to be recorded at year end, because their net realizable value may be less. Okay, then what else you can do? If any repair cost is being incurred on some of the inventory, if any repair cost is being incurred, for that repair cost, what you can do is that you can check that whether the repair costs are properly recorded in the car records or not in the inventory, because those will be considered as cost to sell. Okay, review inventory cost records. If any used car is repaired by management, because that need to be considered in cost of inventory. Okay, in used cars, management may have to incur repair costs on used cars to make them saleable. Okay, so you have to design the procedures, but you have to make sure that you specify yourself to valuation thing. Okay, so you can discuss that how they determine the trade-in value. You can review the market data. You can review the subsequent period transactions. You can review the inventory cost records, that if any repair cost is incurred on the used cars. So for the used cars, that cost need to be included in the cost, because that is your cost to make the inventory saleable. Okay. Similarly, if you remember in the inventory records, what they are saying is they perform the year-end count at 31st March and then they do the roll forward transactions. So you need to review those roll forward transactions that whether they are properly recorded or not, because obviously that will impact the closing stock value of the used cars. Okay. Review roll forward transactions done by management after performing physical stock count on 31st March. These roll forward transactions may include sales and purchases after the inventory count date. If they are not properly recorded, then closing stock value of used cars may not be correct. Okay. See, when you are writing the procedure, I always say to my students that what you need to understand is that every procedure worth 1 mark. But when you are writing the procedure, make sure that you write it in detail. What the procedure is, what will it verify, and how will it verify that thing? Like, what is the entire process? Talk on that. Like when you're saying roll forward transactions, what will you verify in roll forward transaction? The sales and purchases. When you are saying that, okay, we'll review the inventory cost record. So what you are looking for in that? You are looking for the repair cost, that whether it's included in the cost of inventory or not. When you are saying subsequent period transactions, so what you are looking for? Why are you verifying it? Make sure that the procedure is complete. Normally, the students think that the procedures are the easiest one. But what happened in the actual examination is that the procedures which students write are very brief, or sometimes they are not able to pick up the procedures also. Like many of the students wouldn't be able to identify the procedures on this valuation thing. Okay. Now, when you look at the examiner answer, you write so many procedures, and the students say that, so we can't think about that. Like the examiner will also write about the sensitivity analysis that, okay, if the selling prices fluctuate, what will be the impact on net realizable value and things like that. Because he goes in a lot of detail. But make sure that the 4 or 5 procedures which you have to write will be the normal ones, but you need to understand the approach. Now, it's not rote learning. If someone will say that, sir, give me a list of procedures, it can't be like that. You have to involve yourself in that situation. Think like an auditor that, okay, you have the value of the used cars. What will you look at? You look at its cost. So in cost, you look at the trade-in value. In cost, you look at the repair cost. You look at the cost. Then comes the net realizable value. So for net realizable value, you look at the market data. You look at the subsequent period data. Then there were issues in the count that the count wasn't done at the year end. So you think about that. So in this way, you pick up the procedures. Until and unless you will think like an auditor, you can't develop the procedures. So you need to understand that approach. Okay. And then comes the last part of the question, which is in relation to ethics, ethical and professional issues arising from the directors for Tahoma Associate to provide the system and KPI and providing the assurance. So obviously, being an auditor, it's a concern. And most importantly, even in sustainability, if we assist them in developing the system, how can we become the assurance provider? That will itself become a self-review threat. And what type of services we can provide, we have to discuss that also. So it's an 8 mark question. In 8 marks, again in ethics, the guideline is 1 mark per point. Okay, so when it's 1 mark per point, you have to develop 8 points. Okay, you need to understand the writing approach that 1 mark per point is the approach. Okay, so ethics and ethical and professional issues, first of all, issues in relation to sustainability report and assurance. Okay, so first of all, we have to highlight the issues, and then we have to discuss that what type of services we can exactly provide. Okay, now it's not necessary that you break it in equal 4 and 3. It can be 5 and 3, it can be 6 or 2, that's also acceptable. Okay, so we have to discuss the ethical and professional issues. You can read this exhibit also, that calibrate companies to include additional information within the year annual report which demonstrate the sustainability targets and achievements of the company. Your firm has been approached by the directors of Calibri Company to determine appropriate sustainability key performance indicator. Calibri Company also requires assistance from Tahoma to establish the systems. See, first of all, providing non-audit services itself is a concern. But currently it's an unlisted entity, but it plans to get listed in 6 months. Providing non-audit service itself is a concern. And then they are asking that, okay, develop the systems also. So if we develop the system, how can we give the assurance on that? That they are asking that, okay, give us assistance and then give us a separate assurance report also. So that may lead to self-review issues. Okay, so let's first develop the issues and then we'll advise that what type of services they can provide. Okay, let's look at it. Okay, so let's start drafting the point. If Tahoma Associate, our firm, will provide sustainability report services to Calibri Company along with annual audit engagement, then it may create a self-review thread as some of the values calculated in sustainability report may become part of the financial statements which will then be audited by Tahoma Associates itself. Now, what can be the examples? For example, in the sustainability report, there would be values like charitable donations, because obviously that is part of the social work which you do, or any other amounts which you spend in relation to the society, in relation to the environment. So it may become part of the financial statement itself. Okay, such values may include amounts spent on social work like charitable donations or on environmental projects. Okay, so if we would be providing such services, so maybe they become part of the financial statement which will be audited by our firm itself, so it may lead to self-review threat. So what ethical and professional issues which we can refer here? Okay, Calibri Company is currently an unlisted entity. Therefore, provision of non-audit services can be done with appropriate level of safeguards. However, as it plans to get listed in next 6 months, therefore, risk may increase. The ethical issues may increase. Okay, if it gets listed before issue of audit reports, then in that case, non-audit services would be strictly prohibited. Okay, so what you need to understand is that they have the plan to get listed in first 6 months of 2026, and the audit activity is obviously ongoing. So once you get listed, obviously you enter into the prohibited zone. Okay, now another thing is that they have asked us to assist them in establishing the systems. Now, when they are asking us to assist them in establishing the systems, this is particularly a concern because establishing the systems and establishing key performance indicators is a management responsibility. It is not an auditor or an assurance provider responsibility. Okay. Now, Calibri Company has also requested our firm to assist them in establishing systems to measure sustainability data and to establish key performance indicators also. This is an area of management responsibility. As being an assurance provider, our firm cannot become part of establishing controls and measurement processes. Okay, see, it's completely logical that they prepare the data, they prepare the systems, and we act as an assurance provider. Okay, so you are referring the ethical issues which exist in this situation. You said that we need to think about the self-review threat for the audit activity. You referred that currently it's an unlisted entity. You referred that establishing systems is one of the area of management responsibility. Okay. And one more thing, since you have to refer ethical and professional issues, you can also refer about the competence. It's not necessary that audit firm always have the competence to deal with the sustainability matters. Competence of our firm also need to be considered that whether our firm has sufficient skills and knowledge to deal with sustainability report matters. Okay? It is not necessary that audit firms have expertise to advise in development of key performance indicators and systems relating to sustainability reporting. Okay, so we need to think about the expertise of our firm also. So what ethical and professional issues exist in relation to the request made by the Calibri company? So you referred that first of all, it will create a self-review threat for our audit activity. Okay. Then you said that we would be accepting the management responsibility. We need to think about the competence of our firm. Okay. So you are referring the issues which need to be considered before accepting this engagement. Okay. Now, so he asked us that what ethical and professional issues exist in relation to the director request. Now determine which of these services, if any, could be provided by Tahoma Associate, like what are the alternative actions we can take. Okay, like we can provide these services by using a separate team. You can refer that we can get ourselves involved in the assurance activity on the sustainability report rather than getting ourselves involved in relation to these development of systems and control thing. And if we are developing systems and control, we can request the management to accept the responsibility of it. Like the final responsibility of establishing key performance indicators should be on the management rather than on us. Okay, so you can advise some corrective actions which can be taken in relation to it. Okay. Okay, so now talking about services which can be provided. Basically, the advisory that what they need to do in this situation. Okay, so Tahoma Associates can provide assurance services on sustainability report along with audit activity if they use separate teams for these two engagements. Appropriate level of safeguards need to be ensured before providing these two services in parallel. Okay, so you can provide assurance services, but you need to make sure that separate teams are available so that the ethical threat can be dealt with. Now, in relation to assistance for establishing systems for measurement of sustainability data and determination of key performance indicators, a separate engagement letter need to be signed to clarify expectations of Calibri company in relation to it. A separate team will assist in this engagement, and this should be other than assurance providing team. See, what you need to understand is that when you are providing assistance in establishing systems and key performance indicators, then obviously you cannot use the same team to provide assurance on it. Okay, even in the sustainability thing, I'm not talking about the audit thing. Annual audit is separate. First of all, audit and assurance teams should be separate. Secondly, within sustainability report also, there are two things which they are expecting. One is they require assistance for establishing the system, and then they also require an assurance report. So within that also separate team need to be established. Okay. Now, if service for establishing systems for sustainability reporting is provided, then relevant experts need to be hired if Tahoma Associates lack sufficient expertise in relevant area. Okay, sustainability systems and processes may be different from normal assurance activities. Okay, so we are talking about that, how these services can be provided. Lastly, Tahoma Associates need to make sure that if services for establishing systems and key performance indicators is provided, management accepts final responsibility of it. Role of Tahoma Associates should be of advisor or subordinate to management in this service. Otherwise, it will conflict with annual audit activity, as Tahoma Associates would otherwise be accepting responsibility for management work. Okay, so just try and understand like how we have drafted that. First, we referred the ethical and professional issues that, okay, we are providing annual audit. Now, if we get ourselves involved in this sustainability reporting, so many of the things included in the sustainability report will become part of the financial statement of which we are doing audit. So it will create self-review thread for our annual audit activity. Then we highlighted that, okay, it's an unlisted entity, so currently we can provide. But it is getting planned to get listed. So in that case, it will become an issue. Then we referred that if we provide assistance in establishing these systems, it would be like accepting management responsibility. Because in the audit, this is the management work to establish systems and control. And we highlighted issue in relation to competence. Then we discussed that how these services can be provided and what extent it is acceptable. We said that, okay, if you want to provide these services, use separate teams. We highlighted that if you are providing these services, make a proper separate engagement letter, clarify the expectation that what they are expecting from us. Like they said that, okay, you have to assist us in making key performance indicators in systems. So what are their expectations? Okay. Then we highlighted that, okay, if we are providing the services, then we need to look at the competence thing, that whether we have the expertise, otherwise we need to hire the experts. And lastly, we said that if we are providing these services, we need to make sure that the final responsibility is of the management. So if we look at this question, see, what I believe is that if you look at the business risk part, it's normal, like businesses normally come in this way. Okay, like drafting of business risk. Then when you look at risk of material misstatement, that's also the routine thing. But the justification thing, this is something which you are looking in the recent exam papers. Procedures are routine. But in relation to sustainability reporting, 8 marks for this question were too much because it was a very small exhibit for which he gave you 8 marks. And he made the requirement in a different manner, that he divided it in ethical and professional issues. And he said that determine which of the services, if any, could be provided. So you had to discuss that. So it was a bit non-routine type requirement in relation to ethics, where for a very small paragraph he provided you 8 marks. Normally for ethics there would be a bit more detail, so it's easier to develop the points. Okay, and normally in the single requirement he said that okay, give the actions within that same requirement only, but here he asked you to divide it into two parts. But in overall, if you look at this question, I believe that it wasn't something that where you couldn't score 60 to 70% of the marks, because majority of it, like developing business risk, is not something which is very much difficult. When you talk about ROM, and that is not something very much difficult. Justifications were also very easy. Procedures were also somehow which you can do. But in ethics, there were some areas where you couldn't have scored that much well. But obviously, it's an overall balance of the exam paper. See, I always say to my students that you have studied a topic, that is a separate thing. And whether you would be able to deal with the actual exam paper, that's a completely separate thing. And in order to deal with a complete exam paper, you need to test yourself in that environment. Do some papers in the time situation. Obviously, we were discussing this complete paper, so maybe it would have taken more than 2 hours, but in the examination, you would have around 1.5 hour to complete this question. One and a half hour and some 10 minutes extra, because the total exam paper is of 3 hours and 15 minutes. So it would be like 1.5 hour and extra 7 to 8 minutes to complete this question. So completing it in time is really difficult. So you need to practice that. Okay. Now, in the next class, we'll be looking at question number 2 and 3 of this official mock exam. And once done with the past paper discussion, my enrolled students can obviously send me 3 mock exams for marking and feedback, which are my own mocks, and they can take any assistance which they require. Okay. Thank you, everyone. And I hope that you guys have understood the discussion of our today's class. Thank you.